The financial environment is always changing, and numerous small and regional banks in the United States are experiencing the consequences. Today, we will examine the significant dangers that these establishments encounter and deliberate on possible tactics to avoid collapses. Let's dive in. Small and regional banks in the United States are facing significant difficulties that could impact their stability. At this moment, more than 280 banks are facing challenges with two main issues: the growing amount of commercial real estate loans that are becoming more risky, and the effects of rising interest rates. When interest rates increase, it becomes costlier for borrowers to pay back their loans, potentially resulting in increased rates of loan defaults. This scenario is especially worrying for banks that have made significant investments in commercial real estate, as these loans typically have long durations and are linked to the economy's well-being. Should borrowers have difficulty repaying the loans, banks could encounter substantial financial setbacks. These factors coming together could lead to an increase in bank failures, causing a ripple effect on the economy. Even when a bank doesn't collapse, it could still go below the minimum capital requirements imposed by regulators, which may restrict its capacity to provide loans and assist local businesses. This scenario brings about a lack of clarity for not only the banks, but also for the customers and communities that depend on these institutions for financial services. As the economic environment changes, it is essential for banks to carefully navigate these challenges to maintain their long-term sustainability and the stability of the overall financial system. One major obstacle in today's financial environment is the swift rise in interest rates. When interest rates increase rapidly, it can lead to major challenges for borrowers. Numerous individuals and companies hold loans with either fixed or variable interest rates, and if rates increase, their monthly payments may significantly rise. This abrupt rise in costs can create financial pressure for them, making it challenging to stay current with payments. If borrowers have difficulty handling these increased expenses, they may be at risk of not being able to repay their loans, resulting in severe financial outcomes, such as losing their possessions or negatively affecting their credit ratings. By the end of 2024, it is anticipated that the complexity will increase with a historic $929 billion in loans reaching maturity. This substantial total consists of numerous loans that were initially set to mature in 2023 but were prolonged. When these loans reach maturity, borrowers must either repay them or seek refinancing, usually with higher interest rates than their original agreement. If a lot of borrowers can't handle a higher financial responsibility, it may result in a series of defaults. In general, the increasing interest rates and the approaching maturity of a large number of loans present a significant risk for both individual borrowers and the wider economy. During difficult economic times, regulators are essential for ensuring the stability of the banking system. Currently, they are discreetly working together with banks that are deemed to be in danger of collapsing. Confidential reports are being issued, advising these banks to increase their capital, which is vital for their safe and efficient functioning. If these initiatives prove to be effective, it may prevent a surge in bank collapses that could lead to significant impacts on the economy and individuals' savings. Some banks may opt to increase this capital independently, while others could seek out more robust banks to purchase them, establishing a firmer base for their activities. Nevertheless, the environment for acquisitions in the banking industry has undergone substantial changes in the past few years. The decreased availability of banks willing to merge or acquire others could pose challenges for banks seeking assistance. The drop in purchases could be attributed to a range of factors, such as economic instability and more stringent regulations. Therefore, regulators are dedicated to not only urging banks to increase their capital, but also to discovering creative ways to safeguard the strength and durability of the banking system. The continuous cooperation between regulators and banks is crucial to address these challenges and safeguard the financial welfare of both individuals and businesses. The U.S. banking system stands out for its diversity and uniqueness, with roughly 4,600 banks in total. A notable number of them are small community banks that have a crucial impact on their local economies. Surprisingly, The combined assets of the small banks amount to about the same as JP Morgan Chase, the nation's largest bank, which has approximately $3.2 trillion in assets. This demonstrates the crucial role that community banks play, particularly in regions that are not as economically robust as major coastal cities. They offer important services such as loans and savings accounts, supporting the growth of individuals and small businesses. However, the community banks in this range of assets are currently encountering some difficulties. The banks are starting to feel the pressure from economic challenges, which might affect their capacity to assist nearby communities. This is worrisome because community banks are typically essential for economic growth in rural and suburban regions, offering customized service and recognizing the individual requirements of their clientele. If these banks face difficulties, it may impede development and stability in various areas, underscoring the importance of policymakers and communities backing them in challenging circumstances. The Claros Group conducted a thorough analysis of 4,000 banks and discovered that 282 of them are in danger, with a combined total of almost $900 billion in assets. The majority of these banks are smaller organizations with assets totaling less than $10 billion. This indicates their significant impact on local economies through offering loans and financial services to individuals and small businesses. Nevertheless, a few bigger banks in this group are also encountering difficulties. Even though these banks are not insolvent in a technical sense, they are under substantial financial pressure. This is worrisome, as any additional difficulties faced by these banks could result in decreased availability of loans and financial services in their areas, impacting various aspects such as home mortgages and business funding. The analysis has significant implications for both the banks and the communities they cater to. During times of crisis, banks may adjust their lending policies to restrict access to loans for purchasing homes, cars, or launching a new business. This could impede economic expansion and harm community businesses dependent on bank loans. Furthermore, the failure of these banks may result in job cuts and a loss of confidence in the financial system. Hence, it is essential for regulators, policymakers, and the banking institutions to take proactive steps in order to guarantee stability and assistance for the communities reliant on them. Commercial real estate loans are a major issue. Smaller banks are typically more at risk of interest rate increases due to their larger amounts of these loans. If the Federal Reserve increases rates, it can result in higher costs for commercial real estate loans, which may increase the risk of defaults. Mergers and acquisitions, M&A, offer banks a solution to their challenges. Nonetheless, in 2023, there was a significant decrease in Bank M&A transactions, with less than 100 acquisitions and the lowest overall deal value since 1990. Increased regulatory oversight on M&A transactions has made it harder for banks to consolidate. Regulators are closely monitoring the current state of affairs in the banking industry. They are working together with banks to address any issues that have come up, stressing the significance of improving their financial well-being. One of the main tactics being promoted is for banks to increase their capital or divest some of their assets. This method is intended to assist banks in enhancing their financial position and guaranteeing their continued efficient operation. While there is a chance of experiencing certain bank closures in the upcoming time, the primary aim of regulators is to entice private investment. By injecting private funds, they aim to recapitalize ailing banks, which may stabilize the financial system and ultimately decrease the number of failures. In this situation, regulators are not only responding to issues, but are proactively searching for solutions to create a stronger banking system. They strive to enhance the financial environment by encouraging banks to be proactive. Emphasizing private capital is crucial as it can supply banks with essential funding for recovery, reducing their dependence on government assistance. This approach benefits not just specific banks, but also supports the overall stability of the financial system, ensuring its resilience to future obstacles. In conclusion, although the financial pressure on small and regional banks is substantial, there are methods available to tackle these difficulties. The objective is to prevent widespread bank collapses by either raising funds, restructuring debts, or undertaking mergers. We will keep an eye on this situation as it develops and give updates. Thank you for tuning in, and remember to hit the like button, share our content, and subscribe to stay informed about the latest in the financial industry.